Good afternoon, Coppin students, staff, and family. My name is Austin Merritt, and I'm with PNC Bank, and I would like to welcome you to today's webinar on some simple ways on how you can take control of your financial future starting today. In this webinar, we will discuss some ways you can become more familiar with different bank accounts, common bank terminology, bank services, and the importance of building credit now for future success in your financial journey. So let's go ahead and get started. The first thing that we want to start with is really the basics. So with PNC, or just with banking in general, we have two common and very starter accounts, and that's going to be your deposit account, and that's going to be your savings account. In this presentation and in this webinar, we want to really kind of discuss and identify the major types of insured financial institutions, 5 reasons to use a bank, which is extremely important, especially as you're starting your financial journey, describing steps involved in opening up an account, but then also maintaining that account as you move forward as an adult or in your professional careers, or even if you want to start a business. We're also going to describe 2 types of deposit accounts, identify additional bank services outside of the typical putting your money in and taking it out, and then also describe the main functions of a bank and the bankers within it. That way, when you're walking into our brick and mortar branches, you know who to speak with and how to get issues resolved, questions asked, or services provided. So again, what do banks do? Banks are businesses that offer a safe place to keep and hold your money. Again, back in the day, I know it's times and stories that my grandparents used to tell me where they used to put money under the mattress and just hide it just because they didn't know what else to do with it. That's not the option anymore, of course. We have those banks, we have those vessels to hold the money and again, make your money work for you. Banks are also sometimes called financial institutions. So sometimes you might hear that in conversation, TV shows, regular, news, things like that. And just know financial institution equals the bank that you're most familiar with. And then also, like I said, banks just don't stop there. They offer many other financial opportunities and services that you just don't get by keeping your money in your pocket, keeping it under the mattress, keeping it in your wallet, and just walking around with cash. So why keep your money in banks, right? Again, it's the safety, the convenience, the cost, the security, but then a lot of people don't realize that just starting with either that checking or savings account, that also contributes to your financial future. So again, we have different types of financial institutions. So you can either hear banks, but not so common thrifts. They are both, financial institutions and banks that you walk in and see on the side of the road or go to visit, but then also credit unions, which are usually financial institutions that require some type of membership or prior relationship to be able to open up those accounts and experience their services. So as we start as you're walking in, first time opening up an account, let's talk about what ways, one, you open, and then again, ways to maintain that account and eventually grow that relationship and grow your experience. Banks and opening your typical deposit accounts are usually for deposits and withdrawals. You can record interest and fees, but then also keep track of your daily spending, but also set aside funds for savings and possible goals that you might set, whether it's in the near future, 5 years from now, 10 years from now, or even savings that you might have for a spouse or child. So to get started, typically banks just need a few items or information about you to get you started with your either deposit or savings account. Of course, we would need your name, your most current address, date of birth, social security number, or a state or government issued ID. So make sure you have those items prepared, readily available when you are going into a bank and you want to start up that account. So again, the terminology, a lot of times we can get confused with different words or verbiage that's used in financial institutions. And we want to make sure that you know the jargon or know the terminology, that you understand how your banking is going, what you're doing with your money, and just how to conversate with a banker or branch manager or a loan officer to understand really where your money is going and how your money is working. So some common terminology that we use in the banking industry especially when you're dealing with a checking account or savings, is your deposit. A deposit is simply just putting money into the account. A withdrawal, taking the money back out. Balance is the available balance that you have to spend in that checking or savings account. Fees is the money charged by the bank to do different services, whether it's printing a check or providing online banking, just things of that nature. And then overdraft programs. So a lot of banks and accounts might have overdraft protection, or they might have auto transfer to save you from your account going overdrawn and possibly acquiring some additional fees. So we'll break down what's the difference between a checking and also a savings. So the checking account, it typically allows you to pay your bills. Again, you can set up auto pay, you can set up bill pay. Your checking account is really going to be your primary account. If you're getting direct deposit or if you have that debit card, your primary checking account is going to be connected directly to that debit card that you have in hand. It will also allow you to receive monthly bank statements. You will receive those monthly statements to review your monthly transactions. But then also you want to compare the rules of the different checking accounts, because you just don't always have a standard account. You might have a college checking account. You might have a checking account that acquires interest, and we'll talk about that later. But always, when you're walking into a bank, understand your habits of spending. Speak with the banker, bank teller, or branch manager to understand which checking account fits your daily spending habits. And then we have savings accounts. So savings accounts are usually, always a lot different, right? So savings accounts are established to do just that. As a banker, I will always suggest that when you put money in the savings, you try not to touch it at all. The reason why is because your savings account, it pays and acquires and accrues interest. Interest is money that the bank will provide to you as a thank you for letting your money sit. So again, savings accounts, they always have an interest feature on it. So when you are looking for a savings account, be sure to speak with your local banker to see what the interest rate is, but then also different type of perks that come along with the savings account product that you decide to open. Unfortunately, with savings accounts, you cannot write checks. Again, the primary purpose of those savings accounts is to have them set aside, and you really want to not have as much access to those savings accounts as possible, because again, you're putting that money aside for a long-term goal or a short-term goal. So that encourages you, again, to let that money sit, let it accrue interest until it's time to be taken out or used for the goal that you set. But then also, a good thing about the savings account is that you can open it with just a few dollars. It's not like other accounts where there's a requirement amount, where there's a direct deposit that needs to come in there. With most savings account, it just takes about $5 or so bucks to get started. And then we have a few common or not so common accounts that are non-deposit accounts. I'm not going to talk too much about it because, again, we want to really introduce you to those primary checking and saving options that a lot of banks offer. As you grow in your financial journey, please ask questions, please do research, and please look into some other non-deposit accounts. Those accounts will be stocks, bonds, and mutual funds. The difference between the checking account and the savings account compared to stocks, bonds, and mutual funds is that they are not FDIC approved or insured. They are looked at as investment accounts. So it is a gamble where you could possibly lose those funds depending on the action. So please keep that in mind. The stocks, bonds, and mutual funds are not FDIC insured. So the difference between the cards, and just to jump back to the checking and savings options that we offer, or most banks offer, is you're going to have your ATM card and then you're going to have your debit card. So your ATM card is typically linked to a savings account and a savings account only, just in case of emergencies. ATM cards can only be used at ATMs, but some stores do allow you to use your ATM card to make purchases. The best way to tell the difference between an ATM card and a debit card is if you look right at the bottom right-hand side, or maybe on the back, it should have a Visa or MasterCard logo. And that's how you tell the difference between your ATM card and your debit card. So what is a debit card? A debit card can be used almost anywhere major payment systems are accepted. So again, that Visa and MasterCard logo on the card can be used online shopping, when you go to the grocery store, when you shop at different merchants. Almost 99% of the time, you'll be able to use that debit card. And then last but not least, we have those store value cards, which aren't listed or linked to any bank account. It's usually like those prepaid cards. So they are very secure. I am a huge fan of store value cards or prepaid cards, especially if you're going on trips, vacations, things like that, because they aren't linked to your bank account and you're only allowed to spend the amount that's preloaded onto the card. Again, that avoids overdraft fees, that avoids possible identity theft or your account information falling into the wrong hands. So please, as you're building relationships with banks, whether it's with a debit card, checking account, or savings account, still take advantage of these preloaded cards that a lot of banks still offer to protect yourself when you travel or when you are shopping with a merchant that you're not familiar with. So some additional services that a lot of banks offer that help you either access your money, move your money, or just monitor your money. It's direct deposits. That's if you get, you're working and you provide your employer with your account and routing number. Your direct deposit allows the funds to go immediately into your account without having to walk around with that paper check. Another one is a money order. That's a certified payment. That way you're not walking around with cash. That person can receive that check or that money order and deposit it without having to walk around with large lump sums of cash. So again, we want to really, really consider security when it comes to moving the money that you work hard for. Telephone and online banking is another service that we provide. Of course, the most familiar is going to be ATMs. Money transfers. So I'm going to pause there. With money transfers, especially in the day and age that we live in now, where everyone is using their phone, money transfers allow you to do it now without having to, call in or go into a bank or go move money when you have to sit down and talk to a banker. Now you have different options such as Venmo and Cash App. The thing about Venmo and Cash Apps and sometimes other money transfer third-party services, it's not always secure. So please understand that with transferring funds virtually and through your phone, please do your due diligence to make sure that the money is going to the right person for whether it's services or products. Do your due diligence to make sure that your funds aren't being sent or wired to the wrong person. And I wanted to let you know, a lot of banks now have an option that's called Zelle. Zelle is partnered with the major banks all over the country. And that product, that money transfer service, Zelle is usually on your bank app from whether it's any of the larger financial institutions. And that is a more secured option when transferring funds using your phone. Again, we spoke on the debit cards, the prepaid cards that a lot of banks still offer. Those are also services that you can obtain by walking into a brick and mortar branch. We also do loans, and very rarely we do remittances. So when you're walking into a branch, again, you always want to know who the key players are, what titles and services that they provide. That way, you know who to speak with, what services that can be accomplished, and what information you can get from these employees that work in a bank, in a brick and mortar, or even when you call in online or call in over the phone to get additional information on your account or other options that you might have as you are reaching your financial journey or reaching your goals. So the first is going to be your branch manager. The branch manager's duty is to oversee all services within that branch and make sure things are running smoothly, and usually is the last line of defense if you have those questions, if you have any issues with your account. The branch manager is usually able to step in and resolve those issues. If not, push it forward to kind of get those issues resolved, services provided, but then also connect you with people that might sit outside of the branch to help you with any service needs. The bank teller is the teller is going to be the employee that you come in and withdraws the funds or takes the deposit or can provide you over the counter service as it pertains to your account and any questions that you have. Our loan officers are there to provide additional information for the loans that we offer within the bank, as ask or answer any questions that they or you might have as it pertains to interest rates, loan terms, but then they can also process those loans for you if you do need to either get a credit card, personal loan, car loan, things of that nature. The loan officer is going to be your primary person to get those services provided and offered. The last but not least is our customer service representatives. Our customer service representatives typically do not sit within your local branch, but when you dial in by phone or even chat through our website, our customer service representatives are there to assist you with any questions, services, and any needs that you might have. So again, if a branch is closed, if you are in a state where your primary bank is not located, you will be able to contact the customer service representative and still get provided with the resolutions that you would get if you walked into a brick and mortar branch. So we talked a little bit about checking and then also the bank services that provide, but let's talk about developing and kind of really zeroing in on the importance of really utilizing, after you open up a savings account, really growing your savings, and the reason why it's important to grow your savings as you begin your journey for financial freedom, or just reaching your journey, whether it's a business owner or any other goals that you might have for yourself as it pertains to your finances. So a rule of thumb here in the bank is we always say, and we always try to encourage our clients to pay themselves first, especially if you're just kind of starting to work, or you are, new to the job, or you trying to kind of build or buy your first home, things like that. You really want to pay yourself first. And sometimes it can be easier said than done. But what pay yourself first really means is just putting some money in your savings account before you spread the wealth to the other guys. We know bills are important. We know that going to certain events are important, but you worked hard for that money. So set a goal or set an amount, whether it's $5, $10, that you pay yourself first before you start distributing out your check. Put that money aside, watch it grow, let it sit in that savings account, let it accrue that interest. But again, put yourself first. You worked hard for that money. You deserve it. And then you also deserve to kind of check off that box as you reach closer and closer, and check off and cross out goals that you set for yourself, saving wise. So again, pay yourself first. And the benefits of paying yourself first, like I touched on a little bit, is that you learn to really manage your money a lot better. So if you have a portion of a pie, you take it out for yourself. You know how to maybe, let me put 5% of my check here. Let me put 10% of my check. And you can make those adjustments after you already set aside the money for your primary goal. So again, you learn to kind of go with the flow, or try to adjust a little bit. Once you pay yourself, you can use whatever you have left to pay the bills. Of course, can't stress enough, bills are important, but you're just as important. And then also you can improve your standard of living. When you have those savings set aside, as you move forward in your life, whether you're going to buy your first home, the savings that you have will be looked at, and that also holds weight into some of, whether you get approved for a certain loan, approved for a mortgage. A lot of banks and a lot of other institutions look at your ability to save as a way of approving different services that they might offer. And then also, you always want to have a safety net. Life happens, whether you catch a flat tire or your engine goes up, or it's just a hardship that comes up in your life. You want to know that you have some sort of safety net to kind of fall back on, based off of something that you accrued while that hardship wasn't around, or you had a little bit extra. Have that safety net in case of emergencies, because trust me, it'll happen. So you want to make sure that you are prepared. So I touched on it a little bit, and we talked about savings and different in how interest can be beneficial. But I do want to kind of do a deeper dive into two different types of interest. So you have regular interest and then you have compound interest. So regular interest is going to be paid to you for just keeping your money on deposit with financial institutions, sitting it in that bucket, let it grow, let the interest just kind of accrue, not touching it, and just really being really good at not being tempted to touch that money, whether it's to go shopping and hang out with your friends. So you get I look at it as a reward for not doing that and being disciplined. And then also as a percentage of the money in your account. So when you're opening up a savings account, always ask your banker what the interest rate is, because that is a way that you can determine how much interest you'll be receiving based off of the funds that are sitting into your account monthly. And then you have compound interest. That is money earned on the previous paid interest and money already in your account. So again, when you want to think about a good example is that snowball effect of you're getting interest from the bank and then you're getting additional interest the next month for not taking that money out and watching the money that you're already putting into your account. The interest that's coming in will give you some more interest off of those two combined component. So again, compound interest, money earned on the previous paid interest in money that's already in your savings account. You'll sometimes see API, but I want you to know that API is just annual percentage yield, and that's the amount of interest you earn on the yearly basis. So with a lot of savings accounts and checking accounts, they'll send out what's called maybe a yearly review or a yearly recap. Make sure you look for your API because like I said, it's the amount of interest that you earn on a yearly basis. It includes the effects of the compound interest. So if you're not looking at your monthly statements and kind of adding it up and keeping a book, you'll be able to see it on a yearly basis to kind of just track the ups and downs or hopefully the increase of your savings account and the money and the interest that you're getting for, again, being disciplined and not touching those funds. And then also compare the APIs of the savings products to not just interest rates. So let's say 5 years down the road, you become really confident and comfortable with not only your saving account, but then also your checking. You're getting your direct deposit, you know what to do with it. You're moving your money over to savings. You're reaching those goals. You're doing everything right. But now it's time to start building credit. So credit is extremely important because credit allows you to purchase things, whether it's a car, whether it's a home, whether it's emergency funds, without actually using what we call in the industry your liquid cash or the money that's sitting in your checking account. Because at the end of the day, when those hardships happen, you still have rent or mortgage, you still have your car note, you still have to buy gas. So credit gives you a little bit of flexibility when it comes to not using the cash that's sitting in your checking and savings. So why is credit important? Again, it can be useful in times of emergencies. You can use a credit card as overdraft protection or use a credit card that you're not using on a daily basis as a simple safety net. It's more convenient and safer than carrying large lump sums of cash. So times that you might, travel, for example, if you lose your credit card or if there's transactions that you aren't familiar with your credit card, you can report that to the bank and the funds are returned immediately. Or as we start to do an investigation on the funds, you're not being held up with the cash that's in your account, or you don't have to close out your checking account or anything like that, because it's two separate entities that you are also using to make purchases and just enjoy life. It allows you to make large purchases like I touched on, but then it can affect your ability to obtain like a job, to buy or rent a house. As you're starting to see now in our day-to-day, people are doing credit checks. So you want to make sure you are on top of your credit as early as possible. You become almost obsessed with your credit because as we start to move forward on whether you're, like I said, renting, buying, traveling, buying clothes, or just really just trying to grow as an adult, credit is becoming more and more weighted. So make sure you take it serious, just almost as serious as paying yourself first. So a lot of times when you think about credit, you immediately think about credit cards. So it's a few different types of credit cards. It's a lot of different perks that come with credit cards, depending on the financial institution, depending on the promotion that's going on, the interest. We can get into a whole conversation of the specific perks that you can get with credit cards, but we're just going to keep it, again, very high level. So credit cards are just convenient. So you would have that card like you would with your debit or your ATM, but that's what you would swipe primarily with your in the stores or doing online shopping. You would get that credit card. It provides a revolving line of credit. So what that means is you are approved for a certain amount. And as you are using the card and paying it down, that amount that you were approved for, it doesn't change. So as you pay it down, it gives you some wiggle room, or if you're not using it at all, you have that full open availability to the amount that you were approved for to provide and do purchases. Again, whether online, traveling, things of that nature. So really get familiar with the revolving line of credit. That amount that you are approved for stays the same. It's just a balance that adjusts based on how often you use and how often you pay that card off. It requires you to pay a minimum balance. You don't always have to pay just the minimum. I strongly encourage paying more if you decide to purchase or obtain a credit card. Because again, you want to make sure you keep that balance at around 30% monthly, where you're not getting dinged on your actual credit for overutilization. And then the charge card is a little bit different because it doesn't have that minimum payment feature just in case you might be having a tough month. It requires you to pay the entire balance off every single month. So we have stored value cards, and those cards are commonly seen and known as like your payroll card. That's the card that you might get from your employer, where your direct deposit is distributed directly to that card and you can use almost immediately. Government dispersal cards are usually like unemployment cards or other different services that you might be getting payment directly from the government. But then also gift cards and then other general purpose cards. So you might see those gift cards in the grocery store. Those are all great options. They 9 times out of 10 are safe and secure. But the only thing is when you use those cards and you use those options, even though they are secure, because they aren't linked to maybe your social security number, your EIN, if you want things like that, if you own a business, they aren't attached. So you aren't necessarily getting credit to your credit history for using those cards as your primary source of payment or distributing your funds. So that's something that you want to keep in mind. You want to get as much credit for the transactions that you make or the savings that you have. So try to use different bank institutions, those checking and savings accounts, because again, that's tracked, but then it also goes as credit for how you either spend your money and also how you pay your bills. But if you're using a credit card, that does almost the same. It's able to track, hey, you had a balance, you paid it off, or you're making transactions, you're paying them down. He or she is building great credit history. So some common, and a lot of times when we talk about secured and unsecured cards, a lot of the credit products, especially credit cards, are what's called unsecured credit. So unsecured credit just means it has no collateral attached to it. The reason why the amount is what it is, as far as what you're approved for, whether you're approved for $5,000, $10,000, is because we are basing it strictly off of your credit history and maybe your income or the length that you have or started your credit or your credit journey. So collateral is an asset that you promise to give the bank if you do not repay a loan. So when you think about like an auto loan is a secured loan or a secured line of credit, just because if anything happens, that car will play as collateral to pay back what is owed to either the bank or the lender. Consider a secured credit card if you have no credit history or have had credit problems in the past. If you want to kind of revamp your credit or really look at adjusting your credit and increasing your credit score if you don't have any. And what a secure credit does is, instead of having a physical, whether it's a car, whether it's a home, what we usually do is take about $300, $500. We hold onto that as your collateral. And then not only will that will be looked at as your credit balance or your credit limit, but when you're ready to move on to an unsecured credit card, you actually get those funds back. So if you're just starting your credit journey, I would strongly, strongly advise first applying for what's called a secured credit card. And as you grow and as you become more comfortable with credit cards, then you can go into our unsecured credit card options. Also, as students of Coppin or other schools, we also offer, or a lot of banks also offer, student credit cards. Student credit cards have different kind of limits and rules and other perks, because we all know you're just starting your credit, and also sometimes you're just starting your banking journey. So some student credit cards, as you do your research, may offer a lower credit limit, intend for younger customers, again, to give them an opportunity to establish credit, so it's not always as black and white, and it has that opportunity for you to ask questions, maybe mess up, or maybe pay a little bit later, depending on the financial institution and the rules and regulations for that student credit card. Again, your regular credit cards sometimes don't give you that wiggle room. So always do your research and figure out which credit card options, what financial institutions, what products work best for where you are in your financial journey. And remember, please always, always read the terms and conditions on not only the credit card options that you're looking at, but any banking services that you are looking to obtain. Other things that you can get with credit cards, and depending on the credit card type, is you have reward cards. Some of them have cash rebates. Sometimes credit cards give you frequent flyer miles, or insurance if you are, if you are always traveling and you just, again, want to have that credit card that's not linked directly to your debit card. You can get different rewards based off of your spending habits and your lifestyle. So please always do your research, but then also make sure or get a better idea of what the annual fee on the credit card that you obtain. Some credit cards have no annual fee at all. Some of them do. So again, when you're applying for these credit options, or if you're applying for these credit cards, please ask the questions. Please make sure you get a clear understanding before you sign anything at all of what is required to continue and maintain that credit card. As you're starting to grow, especially when you start to get into, leaving college or during your journey within college, you'll start to see pre-approval letters that'll come through the mail. Please understand that even if you're pre-approved, that does not guarantee that you'll get approved for credit. One thing that most of my clients, that I want to really kind of stress with my clients, is that when you apply for a credit card, it does ding your credit report. So please be sure that you take the time, really understand the option, really understand whether or not this credit card is the best option for you based off of your spending habits before you go ahead and officially apply, even if you have a pre-approval letter. Read the agreement carefully, shop around always. And if you're just tired and you're just not ready to make that jump into a credit card, you can always opt out of different letters, calls, different marketing that is connected to different credit card promotions and options. We have that number there right at the bottom of the screen, or the website that you can visit to opt out of credit card marketing. And it'll be shared with all of the major financial institutions to kind of give you a break until you're ready to make that decision. So again, these are just the different documents that come along with, whether it's the credit application, whether it's the loan application. So again, make sure that you're looking at the truth in lending. Make sure you get all of the documents and you simply read what's in that. And if you don't have a clear understanding of what those documents are saying, or you are just a little bit nervous because you don't quite understand, please feel free to go into your local branch, whether it's PNC or the bank right around the corner, and just ask these questions. Bankers are here to help. Bankers are here to clarify information and any confusion with our potential clients or our, already existing clients. So again, feel comfortable to have those one-on-one conversations with your local banker. And then also just look at the terms. Again, you want to read the disclosures to look at fees, grace periods, different APR. That's the interest rate that they charge for using the credit card. So again, always compare what different promotions are going on, especially for interest rates, but then also fees. And like I said, depending on the credit card type, you might get a grace period for making payment to the credit card late that you might get with one bank that you might not get the other. So again, do that investigative work to make sure you're getting the best option and the best product for you. And when I say APR, and when we're talking about interest, again, that's the cost of borrowing money on a yearly basis. It includes the interest and the fees that come along. Again, that annual fee or the interest that you have that comes in every month with your monthly statement. The rate may be fixed or variable. And what that means is a fixed rate is an interest rate that does not change no matter whether it's a month, 2 months, 3 months from now. That interest rate that you got approved for will stay the same. A variable rate is subject to change. So again, that's some information that you want to understand before you apply for a credit card or just a loan in general. What is the variable? What is considered when you are being given your new rate, whether again, quarterly, monthly, or yearly. And different APR comes with different types of uses. So you might get your standard APR from just swiping your card every month. You get that standard interest rate that you are most familiar with once you've had your card for a few months. But then also interest rates or APRs are different depending on the transaction type. So if you do a balance transfer is when you take a balance from one credit card and transfer it over to another credit card service, or another bank or another line of credit. That interest rate is a little bit higher than your standard APR. Cash advances is when you take your funds from your credit card or your line of credit and transfer it into actual cash that you can withdraw from a bank or ATM or a teller. So again, that line of credit is all on that card, but if you do a cash advance, that transitions that line of credit or those funds on that line of credit into actual cash that you can hold in your hand. Again, that more than likely will push a higher APR. So be very, very, cautious before you make a cash advance unless you absolutely need that cash from your line of credit. And then the last one is penalties in case of, it can be an array of different penalties that different banks might charge on the different type of transactions that you have with your line of credit. So again, be sure to read those documents, be sure to have a nice lengthy conversation with your banker, whether in person or calling up customer service with any questions before you apply and move forward with a credit card or a line of credit. We went over some of the fees. Again, it's the annual fees, the late fees, the over the limited fees that sometimes are pushed through if you spend more than what you've been approved for that credit card. Balance transfer fees, which I explained a little bit earlier. Cash advance, credit limit increase fees, is if you apply for your credit limit to be adjusted. It is a service fee for that. Not all banks charge it, but again, that's when you really want to read those documents to ensure you get the full picture of what comes along with the credit card that you're deciding to move forward with. But then also foreign transaction fees. If you travel, whether it's for business, whether it's just to go to Mexico and enjoy the good weather, make sure that you understand whether or not your credit card charges foreign transaction fees. We're getting into a space where it isn't so much depending on, again, if you have a traveler's credit card or if you have a credit card that specifically is created for people that don't spend a lot of time in the country. And when we talk about grace period, that means that you can really avoid or minimize finance charges or paying your balance in full. So sometimes banks, like I said, typically with those college credit cards, it allows you a little bit more time without acquiring some additional fees. Always read those terms. I can't stress that enough to see if that's included, but then also you can get the exact day or the amount of days that you have with your grace period. And many credit card companies never really provide it, but again, you really just want to check because you might find that gem that allows those grace periods in case, again, you run into any hardships. And then other factors to consider: customer service, getting additional protection and extended warranties or extended promotions. Some credit cards will offer you 0% interest within the first 12 months. Be able or keep in mind to really connect with either your local banker or customer service to see if you can extend that promotion, if there's any changes in that promotion. And then also your credit limit. Your credit limit, like I touched on earlier, is just the balance or the amount that you were approved for when you first applied. And when applying for it, it's two options, especially if you are just starting in the credit journey. Individual credit is just based off of your own assets and income. So when you're filling out that credit card application, you are the sole and primary applicant on that credit card application. So the approval will be determined, again, based off of, your credit history, your income, your debt to income, on how many other, bills that you might have. But then also it can be considered, again, and how much liquid assets you have set aside that could possibly repay the debt in case of any emergencies or any hardships. And then joint credit is based on the asset and income of two different applicants that can kind of combine whether their credit history, their ability to pay, their income, and their assets come together to get approval for one line of credit. And then some quick just things to note as we talk about even being able to apply for credit, whether it's a credit card, auto loan, mortgage, things of that nature. You must be at least 21 years of age if you want to apply as an independent application. If not, then you can have a co-signer. But I can't stress enough, if you are trying to apply or if you are applying with a co-signer, please don't provide false information. Providing false information on a credit application is a crime. So sometimes you do have to do your due diligence, whether it's your annual income, whether it's your monthly income, making sure that you put the correct address is all extremely important in the approval process. But then also, again, building a nice, positive, and healthy decor with the financial institution that you're working with. And your credit report. The credit report really is just the quick overview and recap of who you are as a borrower. So please please look at your credit report as a picture of yourself. When you walk into a building, you want people to look at your credit report and say, we can trust this person. We know that they are good with not only with their savings, but also their ability to repay. Being, getting on top of your credit report, you're making sure your credit report is accurate. And then also your credit score is where it needs to be, will open up so many doors for you financially, where you're able to save money, whether you're able to have a low APR or a low interest rate, for you to be able to use your liquid assets to do the things that you want the most and the things that are important, like saving. So again, your credit report just really shows us who you are, how much debt you have, your history in repayment, any negative information that the bank would, need to know. It doesn't necessarily determine a yes or no, but it's different public records. It provides us public record information as we consider, accepting or declining your application. And then also it lets us know the inquiries that have been coming in from different financial institutions or different banks. So when you apply for application, the bank usually reaches out or provides or obtains your credit report from 3 of the major reporting agencies. These names might sound familiar, but the top 3 are going to be Equifax, Experian, and TransUnion. If you want to take a look at your current credit report to make sure that it's accurate, that is not any misinformation or outdated information being reported to those three reporting agencies, we do, and the government provides a free annual credit report that you can either go online and answer some security questions to view your full credit report, or you can call in and have your credit report mailed to you. I strongly advise as a banker that everyone circles that date in the calendar every year to either give a call or go on the website to get that credit report. And then also, if it is any information that's not accurate, please start the dispute process, because we want that picture of you to be as transparent. We want it to be as accurate as possible to make sure that you are being approved for the opportunities that you deserve. And then always keep good records. Just if you do have to do a dispute, you want to make sure that you have the documentation to support any disputes or mistakes that might show up on your credit report. And then last but not least, of course, making your payments on time. That is the story of who you are as a customer, client, and then just as person in general when we are looking to distribute credit. Pay attention and consider, again, your credit limit. How close are you getting to your credit limit? Are you depending too much on your credit cards where you're going over that 30% credit utilization? Are you at least making the minimum payment? Again, earlier I said I always suggest, if you can, pay a little bit over the minimum, but if you can't pay more, at least pay that minimum payment during your monthly statement to make sure that it is no negative markings on your credit report, and how increased payments affect what you owe. So again, the purpose of your credit report is to have different financial institutions, different creditors say, hey, if we lend this person this amount of money, how well will they pay it back? How quickly will they pay it back, so that we can possibly distribute more funds or provide a lower interest rate and things of that nature. So keep that in mind when you're repaying different credit, that all of that stuff is being recorded, all of that stuff is being tracked. That way you can, again, get more access to more credit, but then a better opportunity for possibly lower interest. So with that being said, and I know I've given you a ton of information and a ton of different options as you are starting to, really embark on your journey for, financial knowledge, reaching different goals, and just your journey in general. A few things that I want you to keep in mind is that no one comes into finance knowing everything. So please use the options of your local banker and your local bank to ask as many questions as possible, to do your research, but to know that these options and these services are there to really push you forward as far as making your money work for you, allocating money for future, whether it's retirement, whether again, home buying, buying a new car, going on vacations. Just realize the importance of starting now, starting early, and understanding the options, the services, and really the products that are available to each and every one of you if you, learn, ask those questions, and really start to almost be obsessed with your financial journey and your financial success. Our bankers are always here for you. Coppin is doing an amazing job to create access to financial institutions, and then also bankers like myself to be able to help the students of Coppin, the staff of Coppin, and also the extended family of Coppin to all come together and really hit the ground running and really grab the opportunity to own and really expand on the money that we work very hard for, the credit that will allow us to make those big steps, whether it's through our personal journey or our professional journeys in owning businesses and things of that nature. Again, look at the options around you, look at the tools around you, ask questions, and then always be a sponge, especially when it comes to your financial freedom and your financial future.